On February 20th, 2016, David Cameron, Britain's Prime Minister, set a date for a referendum on the country's membership of the European Union. The move immediately prompted government ministers to declare their backing for either the Remain or Leave campaigns. Some estimates suggest the total economic cost of an EU membership is around 11% of the UK's annual GDP. Those in favor of leaving thought they could better spend this money elsewhere. They also believe, without the EU, Britain could independently pursue international trade deals with China, India, and the US. When it came to government, most Brexiters saw the EU as overregulated as well. Leaving would allow the UK's government and financial authorities to be more free. On the other side, many found there are just as many reasons to stay. With trade, the EU is the UK's biggest trading partner. Currently, 45% of the UK's exports are to the EU, while 50% of imports are from the EU. The pro-EU camp says this access to the EU market balances out the $200 billion cost of the membership. When it came to the workforce, it's estimated that 3 million UK jobs are relying on the EU as well. On Thursday, June 23, 2016, to a vote of 51% to 48%, the UK voted to leave the European Union. Ramifications of this decision will have a tremendous macroeconomic effect in both the short term and long term.
Initially, the effects of Brexit are most apparent in the declining value of the currency of the United Kingdom, the pound, as seen in the graph here. Stephanie Flanders, writing for the Institutional Investor, writes, in the midterm, Brexit could in fact see higher official interest rates and lower growth for a given rate of inflation if leaving the EU lowered the country's supply-side potential by reducing its openness to trade and hurting investment. Growth and investment in the UK are negatively affected by Brexit as confidence in its stability as a trading partner declines, causing investors to pull out. This decline in investment would decrease planned expenditure, coinciding with an increase in the interest rate and lowering income. It is up to monetary policy then to decide whether to hold the money supply constant, hold the interest rate constant, or hold income constant.
After examining the short-term effects that Brexit will have on the UK economy and how it will trickle throughout the global markets, we will look at the effects that it will have in the long run. It is hard to analyze the effects that the vote to leave will have for the UK, but many economists have attempted to predict the effect to future GDP. According to varying organizations, the long-term effects of GDP will be negative. Analysts at PwC think that in 2020, the UK GDP will be down between 3 to 5.5 percentage points. However, analysts at the London School of Economics believe that GDP will be down between 1.3 and 2.6 percentage points in 2020. The effects of Brexit are seen in the losses arising from lower trade. Britain's trade with the EU has been 55% greater than it would have been without membership in the EU. On top of that, there likely will be lower foreign direct investment. Evidence shows that a large chunk of foreign investment, especially in financial services and cars, has come from Britain's EU membership. So without this membership, those industries will be hurt. Another reason for lower GDP are that the gains that proponents of the Leave vote made are largely unrealized. Gains from a fourth possible factor are largely non-realistic. Similarly, growth would depend on attracting talent and skills from outside the UK. However, it is unrealistic to believe that Britons who just voted to leave the EU will allow uncontrolled migration from other countries into the UK. For these reasons, many economists predict that the UK will experience lower GDP in the future.